Hello everyone, and welcome back to another ETF review. Today we're going to be looking at an extremely popular fund on the Toronto stock market, which is designed for current income, and specifically it'll be geared off of the healthcare sector. Without any further ado, let's jump right in. We're going to cover everything that you need to know about this fund from top to bottom. By the end of this video, you will be an informed investor and know whether the HHL should hold a place inside of your portfolio or not. Or perhaps there is a better investment opportunity available for you. But let's go through everything that they have to say. And as always, we're starting off on the fund website itself. I always want to go through their investor materials and see what the fund has to say for themselves before we begin drawing conclusions for ourselves. So, HHL, Harvest Healthcare Leaders Income ETF. Innovative leaders of a vital sector. U.S. healthcare companies combine innovation with consistent demand. We all need healthcare, especially as the developed world ages and the developing world gets richer. Healthcare companies create value from new drugs, treatment, and technologies. HHL offers steady income and growth opportunities from large cap U.S. healthcare leaders. Perfect. Well, that's a very good summary. Let's take a look at the investor brochure and exactly why the fund like this would catch our attention. After that, we're going to take a look at its holdings and how it's performed, as well as how it's competed against some of its competitors in the field. Now, Harvest has done an excellent job putting together some their own materials and research and the benefits of investing in a fund like this, and let's go through it together. So the overview we just read there. Let's jump down to the Outlook Part 1. So permanent and non-cyclical long-term drivers. This is one of the reasons why I support healthcare as a good fund, as a good industry sector to run the covered call or strategies or the wheel strategies off of, as they are not always needed. So let's take a look why. So aging populations. This is primarily a developed market phenomenon. The cohort of people over 60 is increasing rapidly, and an older demographic spends significantly more on money and healthcare needs. Completely correct. Developing markets. China and India's healthcare expenditures going back to 2000 have been growing at about 14% compound annual growth rate, almost triple that of the US, but in absolute terms, still a fraction of the developed world. As wealth increases over time, there is a disproportionate amount of that wealth that is expended on healthcare. So they've said a couple different things there at the same time. So first off, while China and India both have strong healthcare sectors in the growth factor, as we're looking for income from the healthcare sector, we are not investing in those. And so while I think that this would be a good global, as they say up there inside of the overview, 20 large cap global healthcare companies, we're going to see that they only focus on the US, I'm going to assume, because they have a much more advanced derivatives market, and these companies are very deeply entrenched into the healthcare fields, and they are necessary at this point. Finally, technological innovation. This includes things such as robot-assisted surgeries, new medical devices, pharmaceutical and biopharmaceutical drugs. We believe we're in the early innings of a very long game of innovation and discovery. Very true. So things are constantly going to be improving on the technological front, just as new breakthroughs come through. And this is a very long-term goal. People are always going to need healthcare. All right. And taking a look at the part 2, shorter term catalysts and risks. What are the risks of investing in this fund like this? Well, healthcare is a superior good with low valuations. So the healthcare sector has consistent earnings in good times and bad. It is a superior good, something we need no matter what the economy is doing. I kind of touched on that already. So the sector has visibility at a time of significant uncertainty in the broader markets. Yet the price to earnings ratio compared to the market is a very large discount. Relatively, like the PE ratios on some tech companies are very, very high up. But yeah, it is going to be a non-cyclical and very consistent sector. This is one that they're going to be able to dial in pretty nicely. inflation-resistant sector. So large cap healthcare companies have unique advantages in an inflationary environment. They have low commodity price exposure, high margins, financial moats, and dominant market share. Yeah, very good reasons to. We're going to take a look at the companies that this fund holds, and all of them meet all of those criteria. Finally, an interesting point: innovation in obesity-related drugs drives growth and significant benefits. So, weight loss drugs have been one of the major pharmaceutical stories of 2023. I agree. They were all over the place. You could avoid weight loss drugs, and they did reflect quite well in market price as well. Tech and any healthcare company that presented a weight loss drug generally outperformed last year. There appears to be other benefits as well, with researchers finding some of these drugs may lower risk of heart and kidney disease, well, with cholesterol. Okay. And blood pressure, although it is unknown if this is due to the actual drug or the functions of the weight loss itself. I was about to bring that point up, actually. With global obesity impacting millions, controlling appetite through these drugs could be a pivotal role in preventative healthcare, ushering in better patient outcomes and overall well-being. The weight loss industry, already valued at over $280 billion, wow, could potentially soar to over $500 billion by 2032, solidifying these drugs' positions at the forefront of transformative solutions. Some rather flowery language there. So basically, they just want to bring up that, hey, weight loss drugs have been a big winner in the market. Now, we're not exactly sure why they're helping people, but we know that it is helping people, and that it is a superior good that people are interested in getting. All right, investment highlights. Global trends driving long-term growth. Diversified portfolio of 20 large capitalization global healthcare leaders. Attractive income, monthly income with opportunity for global appreciation. Covered call strategy. Enhanced portfolio income and lower portfolio volatility. Yeah, and currency available in Canadian dollars hedged. Interesting. And then we just have a little bit about Harvest themselves, and then they have their own video about that, covering basically what we went over already. Now, continuing on, I just want to point out on the ETF facts sheet, this is the place that I always go to see what the expenses of the fund are going to be. Right off the bat, we see medium. I completely agree with that. It is an income equity, and so medium is a very good rating for this fund. On the risk on a risk rating, but here we are, ETF expenses, and we see a management expense ratio of 99 basis points with another trading expense ratio on top of that of 8 basis points. So 1.07% is what an owner of this fund would be paying every year in expenses in order for this money to be managed for you. So for every $1,000 that you're investing, that's $10.70 that you're paying in expenses. Much higher than index funds. However, you are getting as we'll see, very consistent returns, and being paid out a monthly distribution, which is very reliable. So this fund does perform a very specific function inside of a portfolio and can be good for that. All right. Now, speaking of, let's take a look at right off the bat. I want to say on the front page, we see net assets under management, 1.5 billion. So this is an extremely popular fund, and is being used a lot for recurrent income off the TSX. Management style, active with covered calls. That explains why our management expense ratio is so high. You are paying a professional to watch the market and to sell these calls for us on our behalf. Cash distribution is monthly. Every income investor dreams to get that steady flow of monthly income. And the latest distribution is 0.0583. Now let's take a look at those distributions actually. And let's see, this is something that Harvest is very good for as well. So going back, we see in 2024, and we are looking at the Class A units. Class B would be the unhedged units, and Class U are going to be US dollar. So essentially the same fund. They're doing the same thing, just whether you want to have some currency volatility inside the middle of it or not. But the distributions themselves are extremely consistent, going all the way back to the start of this fund, hasn't missed a single date. So this is very, very good for any retirees who are on a budget and really need to budget every month. Then this is very, very safe and reliable. 2017, all the way back to 2015, that very first year it came out, still getting the exact same distribution every month. And we see during the excitement of 2020 and during that crash there, still you would have had that steady supply of income coming in. Very, very healthy and nice to see. Looking at the portfolio breakdown, now remember it said this would be a global fund, but we're going to see that we're only investing in the US. So we've got 98% inside the US and basically some other cash holdings. So I think it's because they're going to have a very large cap available to them, and that they're also going to have a very strong derivatives market. So that's probably why they're focused on the US. Looking at other global funds, healthcare funds that are focused on growth, there will be a smattering of other countries across there, but it is still primarily dominated in America anyways. And a pretty good split across the board, 33% into pharmaceuticals, healthcare, equipment, life sciences, a little bit of biotech in there. Nice. So these names, 20 names, are going to be very recognizable to anyone who's pays attention to this sector. Eli Lilly, Abbott Laboratories. You're going to see Johnson & Johnson down there, which is probably known for, it must have Johnson. There it is, Johnson & Johnson, known by everybody. So these very, very large cap, well-known names which have established themselves in the industry, probably not going anywhere anytime soon. And even if one does tank, it's unlikely that you'd have all 20 of them tank simultaneously. Not entirely sure what would happen to the healthcare industry if that happened. And performance. All right, how is it done? A 5-year performance, just over 10%. If you've been holding since inception, over 7%. So as far as a buy and hold and forget fund that you can have current income coming from, yeah, solid. These guys are doing a good job. They certainly have this one locked in, at least. And calendar year performance, we see that there is only 2 down years. 2014, probably when they were initially figuring out the fund itself, and then 2016, that was a down year straight across the board for everybody, as the Canadian market was playing with some interest rates during that time. It was not a great investment year. But other than that, it's been completely positive, even in 2020 and 2020. Yeah, 2020, looking over 5%. Very solid. Now, cumulative market price. This is an interesting take on it. So going back to 2016, we can see that the share price was $7.92 and has stayed around that level throughout its runtime. So if you were just having those cash distributions, then your investment would be, had you gone back to, 2016, October, so Halloween of 2016 to a holding period of today, you would have, had you invested back then, the market price plus cumulative distributions of $13.38, starting out with $7.92. $7.86, I suppose. So, a very solid return. What I take away from this chart, though, is that you should just be either collecting the cash distributions yourself and spending them, or that you should be waiting to reinvest this fund for yourself, because the share price is going to be exceedingly volatile. And if you're able to lower your cost basis on a lot of the dips, you're going to perform much, much, much better than just having a dividend reinvestment plan turned on. And finally, I love it when funds do this, showing just how 10 grand would have, how much you'd have now. So based off of December 2014, if you had dropped 10 grand into HHL, you now have 19 grand. Certainly nothing to sneeze at. You could have done significantly better in different funds in different ways, but looking for diversification into healthcare, nothing to laugh at. Now, talking about the actual returns of the fund itself, let's take a look. So here we are on TradingView, and let's take a look at this going all the way back. I've put HHL up against some other healthcare funds on the TSX run by different companies, just to see how their returns have compared against each other. And this is going to be a adjusted dividend adjusted return. So we're taking a look, assuming that we're not taking any money out of the market, that we're just buying and holding, or I shouldn't say that. Actually, I mean the other thing. Assuming that we were just to let this fund go on a dividend reinvestment plan, completely hands-off investor, how would it have performed against Life's competitive fund, CI Financials, and Brompton's fund? Here we see on a 5-year timeline that Brompton has underperformed, but the rest of them are very, very similar together. So Life and FHI, yeah, coming out a little bit on top, but we're all within 3.5% of each other. So ideally, this would have done quite well. Now, I always like to take a look at the 2020, particularly. Let's go up to March 2020, because this is when we entered a brand new investing environment, and things have been a little bit more rocky since then. And we see that HHL comes out on top. So inside of this new investing environment that we are in, that HHL has been the winner. Going back to January of that year, yeah, 100%. So straight across the board, if you were just a buy and hold investor, HHL has slightly outperformed inside the new investing world that we're in. And on a 1-year timeline, yeah, HHL has significant outperformance. Now, I also want to bring up attention to another fund. So here we see at the very top, the Harvest Healthcare Leaders Income ETF. There's an enhanced version of this fund as well, HHLE. So let's take a look at this. And as we can see, it's basically just HHL with a little bit of leverage inside of it. So we're going to be holding HHL at about 125%. Portfolio. Yeah. So essentially, if you just wanted HHL with a little bit of leverage on top of their natural leverage so you can amplify your own returns to the market, this is a built-in way of doing it. So let's take a look at HHLE and add this up to the top of the chart as well. And this is the reason why this is the fund itself that I like to invest in, and I do enjoy buying into at a very good price, particularly if you're under the $10 mark for HHLE. This is as we've seen, HHL has been a solid fund that's been running consistently for a long time. There's no reason not to. If you are a buy and hold long-term investor, there's really no reason not to buy into HHLE instead, and just enjoy the extra 23% it returns. And here we can see HHLE has outperformed HHL quite a bit. We can expect them to perform very, very similar. However, because there is a little bit of leverage, it'll have slightly more vicissitudes to the market, but really I'd say no reason to buy HHL at this point. Just buy HHLE. Buy it for a good price. And we see the current net asset value as I'm recording this. This is February of 2024. Stock valuations are quite high, and there's been a nice rebound off this. I personally got in at under the $10 mark. I've been watching this fund for a while, and I wanted to add it to my portfolio just because I like the idea of diversifying and over expanding myself into healthcare, and it seemed like a good way of doing it at the time. So I'm going to wait for the price to drop down a little bit and then lower my average cost basis on it. But this is a very, very solid holding. All right. So now that we've looked at some income funds straight across the board, we've looked at how this has performed. Let's take a look if you didn't want to take a look at just one sector. So I'm going to bring up a couple other ones as well. Let's say that you wanted to invest in a different income fund that is also very popular in Canada. This is run by Canoe. It's called the EIT Income Fund. And there is another covered call fund run by Horizons, which is across the entire US stock market. These are both very long-running funds as well, and they don't have any leverage involved in them. They're just giving you the raw, unmutated returns of the market. And we can see that while HHL has done well over this runtime, it has significantly underperformed if you were to invest in an income fund from Horizons, or if you were just to buy one of the more popular ones, the Canoe's income fund. Overall, they would have had higher returns. Now, let's take a look at some different periods of history and just see how these have actually stacked up, as that is a very specific return date. So looking at back of January of 2015, boom, we see significant outperformance by these two funds overall, particularly by EIT overall. Now, EIT does have quite a bit of rockiness inside of it, and as we can see, it crashed much harder during the 2020 excitement. However, it did bounce back much higher as well. So again, this is a good one to get in at a good price, or I'd say both of these are. USCC as well. USCC is going to be just the entire broad-based US large cap. So instead of just going off the healthcare sector, we wanted to go off of all US large caps. Now, once again, I really want to look at this new investing environment that we find ourselves in. We'll go into February of 2020 to today, and we can see that HHL has performed about as well as USCC. So that healthcare industry really has come back strongly. They've done exceedingly well, especially over 2023, and that along with a different tech sector, which USCC is going to have a lot of. Now, EIT, the Canoe's income fund, it doesn't hold a lot of tech and has outperformed, as we can see. There's a very, very, very big dip during that 2020, so it did crash much harder, but it has come back much stronger as well. So now we have both of these funds have also paid out very steadily monthly as well. So there we see some returns just about how different ones have performed. Now, just out of curiosity, what if we had bought XUU instead? That is the entire total market index. Now, would you look at that for taking zero risk for a completely passive hands-off investor who didn't need the income? Buying the entire US market would have outperformed almost everything here. Although, oddly enough, we see just over this little time period that Canoe EIT has done a little bit better. But it really shows that if you don't need the income today, investing for the income becomes unnecessary. Ooh, look at that. EIT even outperforming the total US stock market, but the total US stock market outperforming both of those as well. And just out of curiosity, what if you bought into the S&P 500? Yeah, basically the same returns. That's going to follow the US stock market quite a bit. Oh, I take it back. There we have the S&P 500 being still being the best investment vehicle around for total returns. So here we see, if you were looking for some diversification off of your income side of your portfolio, this could be an excellent choice and addition to your portfolio, as it is very specifically weighted towards healthcare, which is very dominant in its industry and will perform well in the future. All right. So there we have HHL. So this is a good one to buy into if you can get in at a good price. Essentially, the biggest takeaway from this is that HHL is going to allow us to get current income, very steady current income from the US large cap healthcare stocks. It's very, very steady, a buy and hold forever fund. Really good to get in at a lower price cost basis so that you're able to lower your cost basis. Not necessarily great as a dividend reinvestment plan option. And finally, if you are interested in a fund like this and you are interested in buying it, it's very fortunate that we live in the future and that HHLE, its larger alternative that has a little bit of leverage, is available to us. Now, whether you hold HHL inside of your account or not, whether you're up or down on it, just know that if you are investing at all, you're far ahead of your colleagues on the market. Let's say you're doing very well, and that you should be proud of yourself. That looking at funds like this, looking at these returns, seeing how that they take a place inside of your portfolio, and you're increasing your own understanding of wealth management, is an exceedingly noble undertaking, and you should feel pride and be happy with yourself that you're doing it. Now, if you like HHL, if you hold it, or if you have one of those drip plans set up, I'm very curious to hear about it. And if you enjoyed the video today, please like, comment, share, subscribe, what have you, do all that YouTube jazz that helps the algorithm. And on that happy note, I will catch you again soon. Take care, everyone.